So today's lesson is based on the basic accounting equation, the most important topic in accounting. It's very basic. In order to master accounting, you need to know the basic accounting equation. What is the basic accounting equation? By accounting equation, we are referring to a relationship between the elements of accounting: assets, equity, and liabilities. Those are the elements of accounting. So by accounting equation, we are referring to a relationship between the three elements of accounting. So accounting equation, it can be expressed as follows. Assets equals to equity plus liabilities. Equity is equals to assets minus liabilities. Liabilities is equals to assets minus equity. So the value of assets is the sum of equity and liabilities. Why? Because equity and liabilities are financed by assets. Okay. Now, what are assets? By assets, we are referring to the resources that are controlled by the enterprise for future economic benefits. In simple terms, the belongings of the business, what the business owns. Assets increase on the debit side and assets decrease on the credit side. What do we mean by debit side? We are referring to the left-hand side of the ledger account. And credit, we are referring to the right-hand side of the ledger account. We have different types of assets. We have non-current assets, which refers to assets that are held, assets that are owned for a long period of time, such as land and buildings, property, machinery, equipment, vehicles, long-term investment. These are the examples of non-current assets. By non-current, we are referring to a long-term, something that you own for a long period of time. Any questions so far? No questions. All right. What about current assets? Assets that are owned or are held for a short period of time, such as your debtors control, people that owe the business, the money in your bank, the inventory, petty cash, the cash flows, the expenses that are paid for future use, the income that is outstanding, accrued income. These are the examples of current assets. The business owns these assets for a short period of time. Are we still together?
Yes.
Perfect. Now, equity. By equity, we are referring to the net worth of the owner. In simple terms, the belongings of the owner, belongings of the entrepreneur, the one who takes an initiative by starting a business. His belongings in the business are classified as equity. Equity accounts consist of capital, drawings, income, and expenses. Equity increase on the credit side and equity decrease on the debit side. By credit, remember, we are referring to the right-hand side. Debit, left-hand side. Capital and income accounts, they increase the value of equity. What do we mean by capital? The contribution that the owner makes into the business. What do we mean by income? All the money that is generated after the business operations. So these two items, they influence the value of equity positively. But what about drawings, the money that he withdraws, the stock that he takes from the enterprise, and expenses, the items that he paid for the business operations, they decreases the value of equity. So if equity decrease, that transaction will be recorded on the debit side. And then if equity increase, that transaction will be posted on the credit side of the ledger account. Now, these are the example of income accounts: the rental income, the commission, the dividends, the credit losses recovered, the profit on sale of non-current assets, the sales, and the interest income. Any question based on these examples of income accounts?
No question.
Thank you very much. Can move on. Expenses. We all know expenses, but within the business environment, these are the example of expenses: the rental expense, the telephone, the stationery, water and electricity, advertising, credit losses, interest, packing material, stationery, repairs and maintenance, loss on sale of asset, carriage and sales. These are the example of expenses. Don't forget that these items, they influence the value of equity negatively. Hence, they are debited. They are recorded on the debit side of the ledger account. Liabilities. The word was derived from a Latin, it's a Latin word. It was derived from the word liable. If they say you are liable, you are responsible for paying someone. You are liable. So liabilities, they represent the present obligations of the business. In simple terms, the debts of the business, what the business owes to other organization or individuals. Liabilities, just like equity, they increase on the credit side and decrease on the debit side. We have two categories of liabilities: non-current liabilities, which represent the debts of the business that are paid for a long period of time, such as loan and mortgage bond. And then we have current liabilities. By current liabilities, we are referring to the debts that are paid within a short period of time, short-term debts in simple words. These are the example of current liabilities: the creditor's control or trade and other payables, the short-term loans, income received in advance, accrued expense, current portion of loan, bank overdraft. So the common question is that, why is income received in advance a liability? So as a businessman, if I receive a tutorial fee in advance, I will be liable to offer a service. So it's sort of a debt to me because I've received income in advance. Now I'm supposed to perform, I'm supposed to deliver a service. Now, why is it a current liability? Because I'm gonna deliver that service within a short period of time. So income received in advance is classified as a current liability. And what do we mean by accrued expenses? We are referring to expenses that are due, expenses that are outstanding, not yet paid. Any questions?
Can electricity be an accrued expense?
Yes, any expense can be accrued as long as it's not paid, as long as it's outstanding.
Thank you.
Can you please also just explain the current portion of loan?
By current portion of loan, we are referring to installments that are made towards a loan. So if you take a loan of 500,000 for 5 years, and then the loan agreement stipulates that every year you need to pay 50,000. So that 50,000 is a current portion of a loan. It's what you're supposed to pay within a short period of time. So it's classified as a current liability because you are expected to pay that amount within a year. So another definition of current liabilities is debts that are paid within 12 months. Debts that should be paid within 12 months. So a current portion of loan is always expected to be settled within 12 months.
Okay, thank you.
More questions, please?
No.